name's David Ramirez. I've been in credit and funding for 10 years. Today I'm just going to break down your personal credit profile, like how to actually increase your score and like all the little credit hacks. And at the end, I'll also tell you basically the four C's of credit for mortgages and then business finance as well, like the things you got to really focus on. But first, you need to understand the credit algorithm, okay? And like what actually goes into a credit score. And by the way, if you see me looking over here, it's because I'm recording a YouTube video to my YouTube people. I got TikTok live. Anyways, uh, basically, here are the credit score ingredients, okay? And it's only 1, 2, 3, 4, 5 things that you need to look out for, okay? Here, I don't know if y'all can see me. It doesn't matter. The most important thing is this anyways, right? And so the 5 things you got is the payment history. That's 35% of the weight is your payment history, okay? Utilization's then 30%. The length of your actual, I should probably stand over here. So then the length of your actual credit history is 15%, and then the actual credit mix is 10, and then the new credit's 10%, okay? So basically, like, what it really means, if you notice, it's actually tracking your habits. That's what it does, okay? It's tracking your habits. And so at the end of the day, you always have full control of your credit score because the payment history, it's as simple as like just pay on time, right? I gotta get my marker, but basically, how do you fix this? Pay on time. There's no other way around it. And it's like, okay, cool. How do I manage my utilization? Have a budget. Okay? And this is why I get so upset and annoyed when people are marketing the credit hacks, because I know that it's all just habits actually. And like the credit hacks do and don't work. And again, we'll just take a look. So we got payment history, you pay on time, utilization, budget, the length. Well, you just wait, right? And actually, I'll tell you how to hack this piece here, but you just wait, okay? Now the mix, you just add them as you need them. Like, there's gonna be people out there that say, go and do this. Like, they're gonna want you to go and take out like actual personal loans and things like that. And there's a way to build the credit, and I actually have a separate video on building credit and like how you can do all that. But first, you just need to understand the basics, right? And from there comes new credit, right? How do you manage that? Well, maintain apps, right? And so, boom, these are the 5 things to your credit score. And I know it's very silly, like, why are we like just learning the very basics? It's because a lot of this is not taught in school. And to this day, I still have people that ask me how to do all that, right? So anyway, now, if you look, pay history is 35%. All you got to do is pay on time. That is like, I mean, there's no other way around it. This is the most important piece, and then utilization after that. Really, if you just focus on these 2 things here, the payment history and utilization, then you're always going to have a solid score, okay? And that's all you got to do, and it's just payment habits, okay? So basically, these 2 things here, that equals money, basically, for you. And the reason why is like for the financing, right? If you focus on these 2 habits here, your score shoots up. And the most common reason people get denied behind negative history, so like collections, late payments, defaults, etc., is going to be the utilization after that, okay? And so that's basically what it is. Now the length, again, you just have to kind of wait. There is a way to age hack the history, and the way you age hack it basically is you can add authorized users. Okay, again, I don't want to actually confuse people. I'm not going to get into all the little hacks and how to do it. First, it's just more important to understand the basics. Okay, so we're just gonna like not even go there. So the length, you basically just have to wait. The mix, you add as you needed, right? And then the new credit, you maintain the apps. And so the most important thing that you need to understand is that this means that everything is habits, right? And so then once you understand that it's mainly habits, you can actually create a financial plan to go ahead and actually get you ahead, okay? And I guess like the key thing is to just understand that piece. If you just understand these 5 things, then everything else makes sense. Now, basically, how can we like improve our score? Like, what are some ways that we can do that, right? Now, for the payment history, credit repair. You just have to delete some items if you have negative items, right? I'm not gonna go too deep into the repair and like how that works. Uh, Regardless, though, that's how you do that. And then utilization is just all about budgeting. Like you just have to create a budget. Oh, and I should probably clarify the difference between utilization and then debt to income ratios because they're not the same thing. Debt to income and utilization is not the same. Okay. Now I'm gonna go ahead and erase this. If y'all need to take a screenshot, take a screenshot. If not, you'll get a recording of all this. Okay. Where's my mark eraser? I always lose the eraser. It's in here somewhere though. Oh, it's right here. Okay. So now that's the credit score ingredients. Okay. And I spelled it wrong. Whatever. Y'all get me. Okay. Now we need to look at DTI versus utilization and the differences. So I'll just go like this. DTI right here and then utilization. So, oh, and then like this is how I abbreviate utilization. So verse. Yeah, whatever. Utilization. So DTI versus utilization, not the same, okay? So first, what's utilization? It's a calculation based upon all your available limits, like your credit limits, okay? That revolve, okay? That and basically what revolves every month, credit cards revolve every single month. So that's a revolving account, and that's what affects utilization. So credit cards, lines of credit, HELOCs, etc. So then, like, if you have 5 cards, right? So let's say you got credit card 1, right? Credit card 2, 3, and then 4, right? So 1, 2, 3, 4. And let's say on this one you got 100. This one's I don't know, out of 1,000, right? And this one's at 0 out of 1,000. And you know what? Let's do 10 because I really don't want to have to do the math. I mean, it's all the same, right? But like, it's just easier with when you do actual correct ratios. Anyway, so that's 10, and then let's just say this is like, I don't know, 5, right? And then this card, I don't know, we're just gonna say you're at $4,000 out of like 20, right? And then this one's also like at, I don't know, 250 out of 10,000, okay? So that means your total available credit limit is gonna be 10, 20, 45,000, right? So 45,000. And you add up this piece here, 100, 4,250, so then you got 4,350. This is utilization, by the way. This is not debt to income ratios. This is strictly utilization, completely different ratio, okay? So that means you're using 4,350 out of 45,000. And then all you gotta do is literally just divide. So what's like, hold on, I have a calculator. My phone's up right here. Dude, I wish I, like, look, I'm in finance, but that doesn't mean I'm a human calculator, okay? So anyway, let me go ahead and do this. So 4,350, right, divided by, what was that, 45? 4,350 divided by 45,000, okay? That means you're at a 9.66, so we'll just say 9.7% utilization, okay? That's what you're using out of your whole limits. And ideally, the utilization, you want to keep it less than 30%, okay? So 30%, no, like, not higher than that, not higher than this, okay? So like, once you start hitting the 30% mark or go over that, then that's when your score is gonna really tank, okay? But if you're below this 30% ratio for utilization, you're good, okay? So you'll be good on that. The golden ratio, I've gone over this multiple times, is 7 to 10% utilization. Okay, if you stay within a 7 to 10% utilization ratio, you're good. Okay, you're absolutely good, and you're not gonna have to worry about like not being fundable. Okay, if you start to get higher, like whatever, like it's like it just makes it harder. I've noticed that as long as you're less than 20%, so 20% less than, right? I'm pretty sure that's how you do it. I forget how to do the little symbols, but what I'm getting at is you want to, if you don't go higher than 20%, almost always I've seen files consistently get approvals. But once you start to go higher than this, generally at the 25% mark is when approvals start to drop. And then at the 30% mark, for sure they're starting to drop. And 35, you're going to get auto denied almost instantly, always, right? So again, this is strictly utilization, okay? This is not debt to income, okay? Don't, like, debt to income is completely different. And I'm going to get to it. And again, if it's just too much, you're going to have to rewind it and rewatch the video, okay? And that's just what it is with this stuff. It's constant repetition. Anyway, so that's that. And then another thing, by the way, that same 30% rule applies to each individual limit. So you'd have to go through each one. Man, I really wish I had a calculator. So 10,000 divided, or 100 divided by 10,000. What is that? That's at, yeah, 1%, right? So equals, so that's 1%. What is that? That's 0%, right? 4,000 out of 20, that's 4 out of, that's a fifth, right? Is that a fifth? Hold on, 1 and then 5, yeah, so a fifth, that's 20%, right? And then that's a problem card, actually. I would be like, yo, this card, let's pay it down if you can, and bring it down to ideally 7 to 10, right? And 250 out of that, that's like also 1%, right? And so what I'm saying is that 30% thing, right? Not only does it apply to your overall utilization, but it applies to each individual credit card. So like I've seen people where, like, for example, this is like a really good example. I've seen someone where it's like $1,000 like maxed out right here. So they're at 100% usage on this card, and then everything else is like this. So like, I don't know, we'll just keep this at 4, right? Actually no, because I want you guys to like really see it. So we'll just say like this is 0 out of 10, right? And then I don't know. Yeah, we'll just say 0, 0, 0. Because this is maxed out, right? And when they underwrite you, they're gonna say you're carrying too much debt. Even though your overall usage is not maxed, it's because of this card right here, right? And so not only do you need to look at the overall usage, but you also need to look at your individual cards, okay? And you gotta bring those stuff down so that you can get approvals, okay? And again, like if you understand the credit score ingredients, then you'll be good, right? And again, it's all habits at the end of the day, okay? Now, another thing is this. What was I gonna say? No, actually, that's pretty much it about that. That utilization applies not only to the overall usage, but then to each individual limit, okay? So that's utilization. And again, it's important to know, because if you understand the fundamentals, honestly, like you just go watch all my other videos and you're gonna see how everything interconnects. And if you're actually really able to understand how personal credit profiles work, then you'll understand how business works. Then from business, if you want, you can even get into commercial or even alternative finance, right? Anyway, so let's go back to this. That's utilization. There's one other thing I want to go over, but it's okay. We'll talk about, oh yeah, actually, for payment history, well, you know what? Let's talk about DTI before we go to payment history. So DTI, okay? So DTI, what is that? That's debt to income, okay? A lot of times, most places, it all depends on the product, but most places aren't going to do more than like, I think it's like 45% to like 50% of your income in debt payments, right? And this is completely different from credit card payments and the utilization, right? So not only you got utilization, but then you also got like your debt to income. And basically debt to income, what that is, it's all your monthly obligations, like actual loan products that you got to pay, not including like hospital bills, etc., added up together, divided by your income, okay? So let's just say in total debt payments you have $1,000, right? And then your income is 5,000, right? So then you just divide this with that, and basic, what is that? 1/5, that's 20%. So you're at a 20% DTI, okay? Which means for like certain loan products, they'd be like, okay, we have about 25% to play with, and that's how they calculate your monthly payment. And this is like the most important thing in a mortgage, by the way, is the debt to income. Is this right here. Ideally, like they can that's how they determine what you can afford, etc., etc. And don't worry, I'll go into the 4 C's of mortgages, the specific things you should always focus on if you want to get a mortgage. And if you don't want a mortgage, I'll tell you like the things that you need to focus on for like actual business finance for like my business owners. Okay? Anyway, debt to income, that's what that is. So it's just all debt payments added up, okay? And that's it. Divide by income, okay? And like if you understand the basic fundamentals to credit and all that, then you'll quickly realize that a lot of these credit hacks, which ones do and don't work, and like why they work, how they work, and then even from like a different perspective, like how to go into the higher levels of finance for those that do this for a living like myself, right? But anyway, that's like the sauce, I guess you can say. And a lot of people don't ever talk about this, which is like another reason why people get denied, and like that's why I'm able to like underwrite files so much more effectively, because I'm looking at also this. And most people that are in business finance, like all those funding companies that do the 0% business cards, that's why I don't like them, because I just know that all they did was take a course, like they just like bought a course, but they never actually went through underwriting stuff, right? Only reason I know how to underwrite is I've been doing this for 10 years, and on top of that, I got my mortgage license. I don't sell mortgages, but like I went through the whole course. I talked to a tons of loan officers every single day, and so I'm able to have educated conversations with them about like certain clients, because I also do commercial, right? But anyway, so that's DTI, okay? Now, what else should we? Oh, now payment history, okay? Let's talk about payment history, because one of the most common things you're gonna hear is you're gonna hear someone say like, dude, get a credit card, put money on it, and then from there, basically, you're gonna want it to report every single month and not pay it back. Okay, basically they want you to carry a balance, and I'm telling you right now, that is not how it works. Okay, if you understand how reporting works, then you'll know that what they just told you is the worst financial advice you could ever get. To go put a balance on your credit card and let it carry, because you're just making the bank rich. Okay, I don't know where the myth came from that, but like let me show you how that works. So payment history and reporting dates. Okay, how's it linked together? I'll tell you right now. Pay history and reporting dates. Check it out. Boom. This is how it works. So, first, what's payment history? How you pay your stuff, right? Now, why is it important to know the reporting dates? It's because on credit card statements, specifically credit card statements, there's 2 dates on them that you need to look out for. Okay. So, what are they? The first one is the due date. Okay. What is the due date? That's like literally the day that you got to pay your minimum, like your minimum payment, okay? That's the due date. You don't really need to really like dive deep into that, and that's fine. So now, so that's what that is. But then you're gonna see something called statement closing, right? Statement closing date. And I don't know if y'all seen it, but typically it's a few days after your due date, right? So your due date may be like the 15th, for example, and then your statement closing could be like, I don't know, 3 days later. So on the 18th, for example, every month, as an example, right? And so it's like, okay, like, why is it important to know when my statement closing date is? Like, how's that gonna help me with like the credit history? Like, how's that help, David? And again, the most common myth everyone tells you is to carry a balance because it's going to build your history. That is not how credit works if you understand these 2 dates. Again, The most important one is going to be the statement closing date, okay? Because and then on some credit card statements, instead of statement closing date, it's literally called the reporting date, okay? And and so what that is, that's when they actually report everything to the credit bureaus. So again, typically it's a few days after, sometimes 3 days after the due date. That means every month on the 18th, right? In this specific scenario, at least every month on the 18th, they report your payments. And so then if you understand that piece and how credit card statements works, then you're going to start to understand that you actually don't have to carry a balance, because this is like, and I work for Bank of America as well, and I can like break down everyone's credit card statement to it like to a science where I can like back it up as well. Anyway, so look, basically, say you spend $100, right? So let me write this all out again, okay? Well, you know what? Yeah, let me write it out again. So let's say, so it's due on the 15th, right? Due 15th, and then let's just say closes on the 18th, okay? And this is how it works, okay? We'll go boop like that, and then yeah, just like that. So you can see the difference. So this is how it works. You chart month one, you get the credit card, right? Month one, boom. Right now, your statement balance is $0 on month one. So, bal equals 0. You charge 100, right? Well, that means now your balance goes to $100, right? And so then what's going to happen, you don't have to pay this $100 today, by the way, right? Because it's credit. What they're gonna, and this is how credit cards work and the statements work. So, and they're gonna say, okay, cool, your statement closes on the 18th, and they'll be like, boom, 18th closes, and they'll be like, okay, this is what we're gonna do: send off to CRAs the balance, okay, and then also after that, send the statement to the borrower, or in this case, let's just say it's me, right? Send the statement to David. They'll be like, send it to David. On the 18th, we're sending the statement to not only the CRA, but then David, right? After that, what happens on month two? It'll say your balance is $100, right? And if you pay us by the 15th in full by the closing date, well, first, if you pay on the 15th, there's no late fees, obviously, right? But more importantly, if you pay it by the closing date, the full balance, so pay in full, what happens to this? It goes 0 interest. Oh snap! So you pay 0 interest, paid, right? And then from there, your balance now goes to 0, which means on the 18th, again, they report CRA, etc., and then boom, send me the statement, right? And again, if you just understand how statement reporting works, anyone telling you to carry a balance to build credit doesn't know what they're doing. They're completely clueless to how credit works. And yeah, I don't know what to tell you. Just don't listen to them, because again, if this is how a credit card statement works, and this is why you do not have to carry a balance ever. Is because like if you understand the payment history and how reporting dates work, right? Then you'll know that if I have a $0 balance and I charge $100, right? That means on the 18th, what they're gonna do is they're gonna bill me and then also notify the CRAs that my credit card now has a $100 balance. And then on month two, what's gonna happen? This $100 balance, this right here, this is from last month, from month one. And if I pay it off in full by the closing date, and then also obviously just pay by the due date so you don't get charged late fees, right? But if I handle all this and pay in full by this date, right? I pay 0 interest, and then also if I pay by the 18th, not only that, it'll report $0. So how can you play around with the statement dates? So what I tell my clients is sometimes I tell them like, yo, make your minimum payment so you're at least not late, right? And then what you can do is say you're like trying to get some cash and then you get a fat payment in, make the payment on the 17th, like right before the statement closes, whatever. It'll post either same day or next, and then what happens is it'll report the new balance, and that's how you can play around with utilization ratios, bringing it down. And like that's the stuff I know how to do. I know how to really time the actual, what's it called, the payment history, or sorry, no, the statement closing dates with the due dates, right? As long as you just do minimums, that covers you for the due date, right? But then from there, if you want to bring it even lower on what gets reported, then just pay bigger amounts before the statement closing date, right? And again, all this leads you into understanding the full concepts of like business credit and all that. And you're going to see how it's all intertwined, right? And as I do more of these, it'll make more sense. And again, you just got to go through and watch everything, right? So now, that's how you do that with the payment history, okay? Boom. So let me go ahead and delete that. I really hope this makes sense, right? The statement closing date stuff. If it doesn't, we can always I just pull out your actual statement one day and maybe we can break it down, right? So that's how that works, okay? Now, these are the 4 C's to a mortgage, and it's going to be all dependent upon the basics that we just learned, right? So a mortgage, this is how you get one. They call it the 4 C's, I don't know why, because, well, there's they literally say the 4 C's, but it's basically down payment, right? Which affects how much you can get. Credit score. There's tons of different programs, right? That I'm not gonna go into every single mortgage program, right? But point is, credit score, income or your debt to income, your DTI, in quotations, DTI, and then from there, the property itself, right? And the reason why that's important is because obviously if you can't afford the property, then it's pick a different property, right? Anyway, so down payment, credit score, income, DTI. The more of a down payment you have, the higher of a score you have. So down payment basically helps with affording more, lowering rates, and low rates, right? Saves you money on term. Because you can literally there's some people that do really fat down payments and they only finance the house for 10 years, right? Not saying that's the smartest or the best. There's all different schools of thoughts and philosophies. All I'm saying is there's people out there that do that and it saves them a lot of money on interest. Anyway, credit score, what's this do? Low rates, better loan programs, right? Better programs. Okay. And then DTI, afford more home. Actually I should say more monthly pay for home. Okay. And these are the 4 C's to mortgages. Okay. And if you focus on these things and the fundamentals of credit instead of all the little hacks that all these other funding companies are telling you to do, then you'll never have to worry about not being able to get the things you want. And I know it's it probably crushes a lot of people's dreams or whatever, but dude, that's just how credit and finance works. Usually people that are promoting those types of hey, I can increase your score within 30 days, a lot of times it's just fraud. I'm telling you straight up, it's just fraud, okay? Or it's a scam. And that's why mine is really my teachings and philosophies are very grounded in the fundamentals of how personal credit works, and that's why my stuff works, because it's yeah, it may take 6 months, a year or two, but that's just how it is, and you're gonna get what you want. But anyway, property itself, obviously if you're looking at $1 million home and you can't afford it, well, maybe look at something that's $500,000, right? Come on, come on. So anyway, this is how mortgages work, right? Down payment, how do you get a bigger down payment? I mean, some people have parents that gift them the money. My mom never gave me any bit of money, so good for them, right? But it's enough about me. You just save money, I guess, right? Your credit score, you focus on those two things I said at the beginning of the video: your utilization and then your payment history. And it's like, okay, how do I make sure I don't overspend? And it's like, dude, create a budget, right? I don't know what to tell you. Like, if you really cannot live on a budget, then like you're gonna have a really bad time with credit. And like I speak from it, like from experience too. Like when I was 21, I got 100,000. I tried to create a business. Long story. 23, I defaulted. But the biggest reason why I defaulted on the 100,000 is because I wasn't really budgeting. Like you can say all like these little excuses, but when I really really look at my situation, I just didn't create a solid plan and budget. Like you can complicate it, or you can just accept the fact that like I didn't do it right. Simple as that, right? So then for a credit score, you focus on those things and ignore the credit hacks. Just ignore them. That's not gonna get you there. Same thing with your DTI, like your income. Like you're just gonna have to budget. Okay, no other way around it. Now let's move on to the 4 C's of actual business finance. Right, it's very similar to mortgages actually. And again, it's not like I discovered all this, but the reason I can like see the full pattern is because I started in personal finance, and then from there I learned business, and now I'm doing commercial. I still do business actually as well. So 4 C's of biz, right? Cred, boom, bop, and it's very similar. So this time it's going to be time in business, right? Your FICO, and then what else? Collateral and revenue. And you can mix and match, and this is why I like business finance, because you can mix and match everything. Like it's like building, like actually just credit in general, the way I see it, it's just a bunch of Legos, and you just gotta match the pieces to certain products. And like that's how I view it. Anyways, so and then revenue, right? Docs, question mark. And then if so, type of docs, question mark, right? So basically your time in business, obviously the older you are, the more you can get approved for like the bigger products, right? But generally like 30 days is the minimum, and that only gets you credit cards, okay? Biz cards. I'll just go like this, CC, okay? Your FICO minimum is 700. Unless you're doing alt finance, we'll just go and like alt fi. You can go as low as like a 500, I think. And I've done these files, but like understand if you got a 500 score and you're going to alternative finance, like it's insane. First, understand everything that occurred in 2008. Every single law that was passed is only for personal credit. There's zero, like you don't have any single rights in business. So then what does that mean? That means like they can lend to you, but if you actually calculate the APRs, you're gonna be paying like there's some loans out there that's like 100% APR, okay? And people do pay it back. Like there's business owners that are like they're just like that. They're like about it. They're like, dude, just give me the money. But that's why I love business owners. Anyways, collateral, not required all the time. Depends on product. And same thing with this, depends on product, right? And so the most important thing that you're ever gonna have to focus on as a business owner, if you want financing, I would say is your FICO, always, and then your revenue. As far as keeping your books clean, right? Because I had a friend in California, he owns a mechanic shop. And so I was like, yeah, dude, I'm happy to like help you, dude. Like, let's figure it out. And he's like, my score's not the best. And I was like, dude, that's fine. Like, we can always figure out like alt finance, etc., etc. And he's like, okay, what do I need to send you? I'm like, just send me your balance sheet. And he's like, oh, okay, cool. It's in a notebook. And I'm like, bro, like, you can't give me a notebook. I can't go to the bank and like be like, yeah, dude, let's look at this guy. Because anyone can just grab a notebook and start writing in it, you know? But that's how a lot of business owners are. And so it's like, dude, you got to clean up your books, bro. Either get a software or start using like Excel, bare minimum, right? But like notebooks, bro, come on, man. Anyway, So now this is gonna be the easiest point of entry, and like typically this is how it goes. Let me just draw a little line here, and then I'll show you how it goes. So anything I'd say less than two, so 2 years and under, 2 years and under, typically is gonna be business cards. Okay. Once you're sometimes if you're minimum 1 year, depending on what you have, you can move into like B locks, right? But for sure, once you're at the 2 year mark, you can go into B locks, and they have sometimes it depends on the state, by the way. Some states do have like what's called stated income lines of credit, right? But not all of them. Not every single state offers it. For example, Georgia is one of the toughest states to lend in, because just about every single bank in Atlanta requires docs. They're like, they don't care. They're like, dude, that's cool that you've been in business for like 5 years, 10 years, whatever, but where's your tax returns? Like, we're not gonna lend unless you have your tax returns. And a lot of it just has to do with the geographic like region, like the economy in those regions, right? And like just Georgia is just known for a lot of fraud. That's the only reason why they always ask for that. Now, back to what I was getting at. So basically, like 2 years and under, generally business cards, the business credit cards, you're not going to have to provide a single thing of document, but your FICO will have to be a 700 plus. Even for the VLOCs, right? The only time you can ever skirt this is if you're doing alt finance, but it's because they're going to be taking your revenue docs. They're going to be like either ask you for the bank statements, P&Ls, and balance sheet, and they're going to base it off that, right? So at the end of the day, like, quickest way to enter and get business credit is to just focus on your FICO, right? Or just learn how to make a lot of money and then just start tracking it all. That's like literally like the two things. Now, of course, if you have collateral, then you can start getting bigger lines of credit, etc., right? I'm trying to think here. Maybe we can go into the thresholds as well, right? And the only reason, like, I'm trying not to overload you guys with too much, but like, it'll be cool to know though, because this is typically when you're gonna get flagged for financials on business credit, right? And I know this because I funded over like millions of dollars straight up, right? We'll do this. So, thresholds, right? Here. And the reason why it's important to know thresholds is because at least on the business side, that's when you're gonna know when they're gonna flag for financials, when they're gonna be asking for collateral, or when they're gonna put a lien. Okay, so I think they might adjust things, but I don't know. A lot of times it's on the state. So anything between like 50 to 100K, generally stated, right? What's that mean again? So no docs, right? Okay, so 50 to 100, typically they're not going to ask for documents, right? Now, you are able, well, we're not going to go there. Anyway, so 50 to 100, no docs. After that, 100K to, I think it's about like 150 to I'd say 100,000 to like 150 is what they're usually comfortable with. Is gonna be also stated, but they may put a lien, I think. Oh no, it's a 2 year, so 2 year business minimum, and then no docs, and that's it, just if they have it available in your state, right? And then generally, once you get to the 150 mark to 250, then they're gonna start asking for docs. Oh no, actually, hold on. So, sorry, that's what it is. They ask for docs here. So 100 to 250. My bad, you guys. Hold on, 100 to 250. Okay, they go docs, right? And then 250K plus. That's when they do docs, collateral, liens, etc. And just because you have a lien doesn't mean that's bad. Actually, SBA always does a lien. They're always going to put a lien, first position, etc. And if you don't know what a lien is, shoot, maybe we'll talk about it one day. But basically, all it means is like they have basically an interest in the business based on like the money they lent you. If you default, they can just come in and depends on the type. If it's a blanket lien on the business, that means like doesn't matter what it is. It's like every single business asset they're gonna come in and liquidate. Sometimes it's very specific as to the actual specific asset. So for example, everyone that has a mortgage right now, the bank has a lien on the house, right? And then same thing with cars, they'll put a lien on the car only, right? So that's why they can come in and they just take the car and they're not taking anything else because the lien is specifically on that asset, right? And so like, okay, how's it work in business? Well, sometimes like say it's commercial cleaning, right? They have a bunch of vans, right? And like those vans are all financed. They default. They'll come in and be like, "Give us back our vans," and yeah, later, right? Or if it's like equipment, they'll come in and take the equipment and be like, "Yo, uh, give us back our oven that we're financing for you. Like that's ours now, right?" So that's what a lien is. And typically you start seeing that at the 250 plus range. Generally at 150 to 100 to 250 is no docs, unsecured, right? Uh, so like no lien, unsecured, boom, right? And again, this isn't always true. This is just like general rule of thumb. And because I know just like how to like source all that information, generally I just call the banks and like honestly the best way to do it is to give them what's called a lending scenario. So sometimes I get a client and a good example is like the tax company I was helping with out in Miami not too long ago, and they didn't have any docs or anything. And so I started calling the banks. I'm like, hey, look, I got a tax business. They don't have revenue docs, right? But the business owner score is X amount. Do you work with businesses that are in this industry? And they'll be like, yeah. If they say no, then move on. But then, yeah, I'm like, okay, great. And I start asking them, okay, so they are interested in a line of credit. I've heard that there's stated income lines here. Do you offer stated income? They'll be like, yeah, absolutely. Or no, we don't. Then boom, next, right? He specifically wanted stated. That's why in that scenario I'd hang up. But my point, you just have a conversation. You let them know what's available, what you can give them, what you can't give them, right? And then same thing with the inquiry. You just ask them like, hey, like what bureau do you pull? Are you gonna put a lien on my business? What type of lien? Is it a blanket lien or is it first position? Are you gonna put it on like specific assets, etc., right? And that's the stuff I can do because I know the thresholds. I know what all this means. And generally, my business owner clients, they're more all about. They're super amazing at what they do in like their specialty, right? So that's that, right? Now, the types of documents that you're generally gonna need are gonna be here: personal taxes. So personal, son of a gun, whatever. Personal taxes, biz taxes, right? And after that, you're gonna need your P&Ls, profit and loss, right? So that's what P&Ls are, profit and loss, and then your balance sheet, right? Okay, those are the things you need. And if you're wondering what all this is, well, basically, just this lets them know that you're filing, how much you make as the owner, how much the business is claiming and filing, and the P&Ls gives them cash flow analysis, right? So there's like cash flow. Right? That's cash flow analysis. The balance sheet just literally tells them assets and obligations, right? That's what each piece tells them. Okay, and again, I'm not a tax professional, but this is like how it's viewed as a business underwriter, right? This is how they view it. So that's why you need to have these things. The personal taxes is like owner income, right? And then this is just shows them that they're actually filing and they can prove it, right? but then like what actually tells them what you can afford and all that is going to be your actual P&Ls, because it's going to show them the actual month to month cash flow analysis, and then even year to dates show them like where it's specifically at, and then the balance sheet as well tells them what assets you have and other obligations, right? And that's how like real underwriting works. All these other 0% people, like, they only know the 0%, and they also do like cookie cutter approvals. They always talk about the major banks, but again, because I have like this deep understanding of how business credit works, how personal credit works, how all the like the credit algorithms work together, I can really cook basically. Like, most people don't even have like the banks I have, and it's not even anything special I'm doing. It's just like I just understand how to underwrite. You know, like, why would I take someone to a specific bank that I know can't get them the amounts based on like the lending appetite that they have, right? And another thing that you can like focus on. So not only do I know the thresholds, or you should look at that, but this is like a step above, and like this is how I really get like the nasty approvals that no one else can get. It's called relationship based lending, and this is what I do, and this is like the sauce. And like, even though I've said this multiple times, relationship lending, a lot of people just don't do it because it takes work. Like, it actually like requires brain power. Not a lot though is what's crazy. So basically, it's like, what's relationship based lending? What are you even talking about, right? Well, it's measured on accounts you have, measured on accounts have with bank, right? And okay, what does this mean? This means you have an internal credit score as well. Means internal score. Everyone's scored internally, by the way, right? They score you internally, and that's why, like, even though you can have like some of the best credit in the world, your internal credit score with that bank is trash basically, and so they're just gonna deny you, right? And so it's like, okay, how can I increase my internal credit score? So how increase, right? How increase? And I'm just gonna abbreviate how increase. Well, if you understand relationship-based lending is measured on the accounts you have with the bank, to increase your internal credit score, open more accounts with them, right? And that's why people tell you to go open accounts with all these banks, right? But there's a better way to do it. I'm gonna tell you right now. But look, open more accounts with bank, okay? And so the way I get my quick wins immediately for my clients is I look at their current relationships, right? And that's why if someone's telling you like, dude, Chase is the best bank in the world, they lend me so much money, I immediately know they have no idea what they're talking about, because I'm like, that's not how lending works, but okay, I can probably get like 50, 100,000 off one single bank based on like specific people's relationships with the bank, right? And again, it has to do with how many accounts you have with them, right? And the more accounts you have with that specific bank, the higher your internal credit score goes with them. And also, that's when they start to actually give you better terms. Like, Wells Fargo is a good example. They do anywhere from $0 to $150,000 on a business line of credit. No docs, no nothing, right? But if they don't know who you are, even though you have all of the tax returns and like everything, they're probably not going to lend you the full 150 like that, you know? Or they'll flag you and all sorts of things. But say you're with Wells Fargo, you've been a client for like 5 years, you have the personal checking, the personal savings, the business checking account, you have a business credit or a personal credit card with them, you've had auto loans with them, they have all this data with you, they are more likely to lend that full 150 than if you were to go to a random bank that does not know you, right? And in like, you don't even need a finance degree for this, because that's just how relationships truly work, even outside of finance. Like, if I'm gonna ask someone for money, if I had a really like, if I really needed it, I'll go to my mom, because she's known me since I was a little baby. I would not go to someone that I don't know, be like, yo, give me $100, you know, like, and that's why it's like, it's crazy to me that no one does relationship based lending. But that's what I do, and that's why I can like promise people like double them like what everyone else is marketing. And also I have a like I understand how to underwrite as well. So basically, check this out. Like um look at where look where deposit accounts are. I'll just go like that, right? And look where your credit relationships are, right? And then go there for the financing first, right? So if you have like so at bank one you have like checking, right? So checking, savings, and a credit card. And then you have a second bank, and let's say this bank too, they only have credit cards. You only have like 2 credit cards, right? Okay, cool. And then you're like bank three, they have my auto loan, right? What I would do is like, okay, I'd be like, okay, we're gonna throw this in the stack. This is the runner up, and then this. So I'll have 1, 2, 3, and then after that I'll do cold apps, right? Cold apps, and then plus account opening, and like that's the difference. Like, you know, there's people out there they're like, oh, you want to have like thousands of dollars to go open these accounts, and it's like there's a way to do it where it's like, yeah, like you can do that, it works, but not everyone always has that, right? And so if you go off the relationship based lending, it opens up doors and makes it easier, right? And so obviously the deeper the relationship or the more accounts you have, the easier it gets, okay? And that's relationship based lending. This works on the personal, business, and all sorts of things, okay? Now, I don't know, you guys, I'm gonna continue to do these videos, these lives, but if at any point in time y'all want me to talk about something specific, let me know. Oh, and then for my people on my live audience, like straight up, like if you ever have questions as to your credit report, like I can do a live report breakdown if you're comfortable with that, okay? So that's my promise to y'all. And same thing with my YouTube folks. Like y'all can just always like hit me up. It's not a big deal, okay? Trying to think here. What else can we talk about? I guess we started off with understanding the basics to personal credit. Then we went into basically how you can start optimizing, right? And from there, we actually talked about how that goes into like mortgages, business finance, etc., right? But it always starts with the personal credit profile, okay? Can't have anything without the personal credit profile unless you have a lot of financials, basically. It's the only way they're ever gonna like skirt the credit score, as they say, right? So basically, you just need to focus on your personal score, your personal credit score. Like the best way to improve it is literally just habits. I wish there was better ways to do it, but that's just what it is. And I don't know, maybe it'll change later, right? But I know that this video will help a lot of people because many people don't know about that. Oh, and maybe I should have told y'all where to get your report. Experian.com, right? You can go here. They can give you all 3. Right? Obviously, you can just go to the same bureau, like the bureaus themselves. Don't Credit Karma. Don't use Credit Karma. If you really can't get a report, go to free annual credit report. All right, so free annual credit report. The only thing is they're not going to give you the actual score. They'll just tell you what's in it, okay? They'll only tell you what's in your actual score. But if you need your actual score, just go to Experian.com, free annual credit report. Don't worry about the different algorithms. Like, there's like, you're going to hear people tell you, oh, focus on FICO 8, focus on FICO whatever, Vantage, all these different scoring models. But if you just focus on like the things I told you guys, which is just understand how the algorithm works, and then you just have good habits, you'll never have to worry about all those little things about credit hacks, all the little like, oh, this score has to be that, you know, and if I don't do this, then I don't get that. Like if you just keep it simple, the best strategies are always simple, by the way, especially in finance, right? And then also if you give the plan time as well, it works, right? It's just that's just how it is. And again, it's not that I don't know credit hacks, it's just that they don't produce consistent outcomes, and a lot of times it hurts people, and a lot of times it's just straight fraud or scams, you know. And that's just not what I do. And plus, I have my mortgage license, so I'm held to a higher standard having the mortgage license, and that's why I don't promote all those like credit hacks, right? But that's that. I think we're gonna end it here. This is a faster one, faster video. I'll go. I'm gonna get a poll and see what you guys really want me to talk about, what pinpoints to hit, and we'll go from there. But till then, I appreciate y'all, and y'all have a good day.